Okay, hey guys, Coach Roel here again with Scott Meyers. Was able to wrangle him from his very busy schedule. Scott, if I can, I just want to jump right into a question that I've seen around some of our social media and actually in some of my conversations with some of the people online. With the US federal election just around the corner,
Mhm.
some people there are some concerns that the economy could jump either way, up, down, or sideways. So regardless of who's elected, what would you say to people who have a little bit of, they're interested in self-storage and the industry, but a bit hesitant as to some of the unknowns that might happen on the other side of November of this year?
All right. Well, you had me going for a second there, Roel. I thought you were going to try to bait me into a political discussion, but you said regardless of who gets elected. So we'll.
Regardless of that, that's not what we're here for, right?
No, it is not. No, it is not. No, extremely good question. We're having a lot of those discussions, as you know, internally, but also, externally as well. And yeah, there's people right now that are wondering what to do in terms of investing from a timing standpoint. We've got a pandemic, maybe heading into round two of that, or another lockdown, shutdown, shelter in place, whatever that looks like. We've got an election coming up. And then again, depending on who you talk to, we're either in a recession or on the cusp of it when you look at the jobless claims and where our economy is at the moment. Other people think that it's booming. Regardless, that has created for fear, or for some people, fear. Others just a lack of clarity, and for many people the lack of clarity is causing that fear. So investment is all about timing, and you make money when you buy versus when you sell. And so everybody wants to know, well, are we at the bottom, or is it the best time? And the answer is, as always, it depends. But we're in a different situation right now, and the fact that where we currently are as an economy is the economy really truly is very strong right now when you look at the individual factors. But we also know that we are printing money, and there are a lot of businesses that have been dramatically affected by the shelter in place, the pandemic, the slowdown, the shutdown. Many businesses have closed, but yet we also have, once again, historically low interest rates. And the Fed just came out, I think, what was it, the 16th, I think is when it was, Roel, that the Fed said zero interest rates for the next till 2023, I think, whatever, regardless, it was last week. So now we can kind of lock in our projections and our exit strategies for a few more years. We know what our cost of capital is going to be from a lending standpoint. And so I'll just tell you, I'm not giving advice, so I'll just tell you our stance and what we're looking at right now. And that is when other people are running out, we will be running in as we have. We've been preparing for this since 2011. We've been continuing to bolster our relationships with our lenders and growing our private equity base, our passive investors, because we knew that this would be the time where some folks aren't able to refinance their facilities and they'll be looking to get out. In this particular environment that we're in right now, there's a number of mom and pops or just folks that have owned their facilities for a number of years that they depreciated them, they paid down their basis. It's time to retire. It's time to even trade in, trade up into a 1031 exchange. And they're stating that now is the best time to sell because one, they're a little bit nervous about heading into this, a looming recession or a pandemic or the election, and they don't know, they want to hedge their bets and they don't know what's happening. So the risk averse folks are now putting their properties on the market. And our marketing efforts, I think we mentioned on another call, we're getting 4 times the amount of calls now and people wanting to sell their facilities.
Wow.
It's not a fire sale, it's not a distress sale, it's just it's time. And so when we look at our capital stack and the cost of capital right now, which is so cheap, we're looking at any and all deals right now. Ones that didn't make sense 6 or 9 months ago are now all of a sudden making even more sense. So to say, now's the time to sit back. I think, we're extremely bullish on self-storage right now and firmly feel that the next, I'd say 9 to 18 months are going to be the biggest land grab in self-storage that we've ever seen. Personally, our portfolio is going to grow quite a bit. We're going to grow smart. We're not going to be reckless about it. We're going to be able to pick and choose because there's a lot of opportunities out there right now, but low capital. Self-storage benefits from a recession, from a pandemic when there's trauma and transition. Occupancy's up, our rates are up, and we only see that trend getting actually a little bit worse because the banks aren't lending on the development projects as they head into this time of a little bit of unclarity. And we know that once again, that when all the government aid goes away, and some of these other businesses and individuals are being feeling the pinch, they are going to be moving in with each other. Businesses are going to be moving inventory into storage even more so than they already are. So that's a very long-winded answer to your question, Roel, but that's kind of the landscape and the way that we see it right now.
But you touch upon a good, interesting point there that lenders are less, are starting to be a little bit less warm to the idea of funding new projects like development projects.
Mhm. Mhm.
So has that been your experience, and what would be the alternative in terms of where these lenders are looking to lend?
Yeah. So from our standpoint, we're active investors in the marketplace, and so we buy existing facilities, and we also convert buildings into self storage, dark vacant big box warehouses, and then we develop from the ground up. So from our standpoint, from an active investor standpoint, our development projects, yeah, banks when they see unclarity and they look at the environment that we're in right now, they tend to step back a little bit, hit the pause button like they did at the beginning of the pandemic in March, and for about 2 or 3 months they wanted to kind of see the landscape, but they're coming back out now and lending again and on development projects. But when times are a little bit sketchy or dodgy in terms of the economy and there is a transition happening, the lenders will tend to lag back, or they'll lower their LTVs from 75% loan to cost on a development now back down to 70, 65%. They may add on a half a point in terms of the interest rate. They just add in these little layers and buffers that sometimes makes it a little more difficult to get a deal across the finish line, or a project that we may have been ready to go on in February of this year. Now, all of a sudden, when you add in those little layers of being a little extra conservative by the banks, now all of a sudden those projects don't make sense. And so it's kind of self-policing. So some of our projects, there's only one project where we've really hit the pause button on that we haven't been able to make do with the new lending guidelines from our banks that we have right now. Only one, and all the rest are still going forward. But what the banks typically will then look at is they're all looking towards self-storage, but existing facilities. They know that self-storage has the lowest loan default rate historically against all asset classes, and again, during a recession, self-storage outpaces all the other asset classes. And so the banks are running into self-storage. They're just running and putting all their money into existing self-storage facilities, but they're being very cautious when it comes to the development opportunities. So what that means in reality is that then we have fewer facilities, new projects coming into the pipeline, but we have a run up in demand. And so that, again, creates, lends to this perfect storm that we're finding ourselves in self-storage right now with these historically low interest rates and, with the team that we have and what we've been able to accomplish in building up our marketing and the relationships that we have. So we're, again, very excited about where we're at. Does that answer your question?
Yeah, there's a point there that what I got from that part of your answer is that existing facilities are a lot less speculative than new development projects, correct?
Mm-hmm. Yeah, because the banks can then historically they can look back, 2, 3, 5 years, and they can say, well, here's the net operating income, here's the revenue that it brought in and the expenses for the past, 3 to 5 years. There's no reason to think that it's going to fall off a cliff, or it's, it should, move forward in the same fashion as long as, the operator has experience and they're savvy enough to be able to take it to the next level. And again, knowing that we're heading into a time where self-storage is actually benefited from what's going to happen in the economy versus you walking in, whether you're an experienced or savvy self-storage developer or not, and say, hey, I found a piece of dirt. I'm going to put a self-storage facility on it. And in 23 months, we're going to begin to leasing it up, and it should be break even at that point. And it's fully stabilized in 34 and a half months. We're going to say, well, there's a pandemic, there's an election, we got a looming recession. We don't know that you're going to hit those timeframes. And what if you run out of money before it gets up to that place? So for that reason, if a confused mind says no, and that works for consumers as well as bankers. So those are the ones that they can pull back from. And if they've got enough deal flow and opportunities to invest in storage to whet their appetite to put on their balance sheet, they would much rather have a facility, that has been historically performing at a certain level that they can predict where it's going to go going forward than not taking a chance, but on those speculative projects, which is development where there isn't any history behind it.
Right. And could you speak to the level of, or the options for control in terms of an existing facility, in terms of turning it around, lowering expenses, increasing revenue? There's that aspect on an existing facility that's just not present in a new development project.
Correct. So with an existing facility, you've got an appraisal that includes all of the historical data, but then we also take a look at the markets now that says, hey, here's where the market rates are, and here's where we project it's going to go. Here's the demographics in terms of population growth, job growth, median income, any new developments coming into the area in a 3 to 5 mile radius around the facility with regards to apartments or high density housing. What are all the factors that are going to lead to the growth of this facility in terms of occupancy and or an increase in income, but also, what does it have in place in terms of ancillary income streams? How are they
Mhm.
managing this? Are they charging a non-refundable admin fee versus deposits? Are they selling locks, boxes, and moving supplies? Are they collecting their late fees like they should? Or are they adding it again? All these income streams that you could add to a facility, not every single one of them, but at this site, do they have a solid business plan that says, here's the inefficiencies and here's where we're going to be able to take the performance of this facility going forward in terms of occupancy, rental rates, as well as all these other areas. And so, if we do this correctly, like we've done in the past and like the competitors are doing, here's where we feel this project is where we can get to, and you can plot the path to profitability on that site. Whereas with development, we're using a feasibility study versus an appraisal. And the feasibility study is all based upon projections because that's all we have. It takes into
Right.
consideration, again, the market and the competition and all those factors. But we don't know for this exact facility because it isn't built yet exactly how it's going to perform and how that market is going to react once we put in another 60,000 square foot in this 3 to 5 mile radius. What comes away from the competitors and how much can we really truly raise rates?
Hmm. Now, in closing here, because we're running pretty good on time.
Mhm.
This is more from the perspective of some of the newer investors, people who have been looking at this, as I'm more of on the front lines with people who have not necessarily invested heavily or have not yet invested at all in self-storage.
Mhm.
Kind of feedback I'm getting is they see it logically that, yes, it kind of makes sense and this and that, but they still have this uncertainty or fear on the other side. And they know that logically it makes sense, but
Yep.
emotionally, what would you say to somebody like that
Yeah.
who wants to get in and they're just stuck on the fence, or there's that fear of taking action?
Well, we see what most folks do, and this is not giving it advice, but many of our folks that are in that position or situation, they either follow us or are working with us closely. They're students or we're consulting with them. If they have that much, they love the asset, they love self-storage, they understand the story, they understand where we're at in the economy right now. It just makes sense. But for whatever reason, they don't want to pull the trigger, can't pull the trigger, or don't want to dedicate the time or the resources. Then there's the passive side, meaning investing as a partner of ours or with anybody in a self-storage facility that syndicates these projects. So they can come along and invest 25, in some cases, $50,000, and in a solid project where we show them the path of profitability and plot that out in terms of an existing facility that we're buying and turning around, or in a development project or a conversion project, all backed by a feasibility study and approved by consultants. And with our experience and track record, and obviously lender approval as well, we put these projects together. That's why so many folks are interested in investing with us as a passive partner, but still enjoying some stellar returns. Roughly 3 to 4 times what they would see in an average return in the stock market or in their mutual fund, and well, a heck of a lot more than if they were putting it into precious metals or in a CD or a mutual or any other vehicle that you can openly buy in the retail market right now, unless they happen to hit it big. This we can see it, they can see it, touch it, feel it. They understand what we do from a standpoint of a promoter and a syndicator and the experience of our company. And at the end of the day, no matter what happens in the economy, self-storage again does very well, but they have a hard asset that produces income, and you can't get that in the stock market or anywhere else except when you're looking at rental real estate. So that's why there's such an interest in, and maybe that's how some folks found us that are watching this video right now on YouTube, is looking for the best asset class or the best investment that hard asset that produces income. It is self-storage, and that's why so many folks are coming along and investing in self-storage and in our projects. That way they become an owner, they have equity in it, which means that they get a K1 at the end of the year, which all the benefits that go along with that, meaning depreciation, plus they share in the cash flow, and then they share in the profits when they sell. It's just a fractional ownership by buying shares in the LLC that we create in each one of these projects in which we partner with our folks.
I guess at the end of the day, there people need to be self-aware of the analysis paralysis, because there's so many positive points that I guess at the end of the day, it's a personal decision. They got to get over themselves.
And I'd say that's where people get to when they realize that either my limitations over here, or I have so many, I don't know what I don't know, and I have so many hesitations. You know what? But I want to move forward. It's really easy to make this one decision to say yes and to partner with an experienced syndicator and promoter to go along, and then receive those monthly reports and the quarterly webinars, and they can learn about the business. They're in it. They're owners, and they can get that education and get that confidence level. So the next go around, then it's time for them to invest in their own. They've already been through it. They're owners, they're partners of ours, and they understand and see what this looks like. And it also puts them in a better position when it comes to lenders and brokers and bringing in their own equity partners, because now they can point to the fact that they are an owner of a self-storage facility. And so they get looked at more seriously by the lenders. And if they're raising their own private equity, and brokers and sellers alike, by having their name attached to as a partner on one of all these projects in which they own it. They own some of it.
Excellent. Well, that's great. Awesome points. I know you're super busy. It's a Friday afternoon as we're recording this. So thanks again. Scott, I have to comment that the virtual background you have looks amazing, because you look very divine.
Yeah. Oh yeah. So I put myself in the middle of it, and with the short haircut and the lack of hair, it makes
it's a great touch. I love it. I vote.
Yeah, it should be offset. It's not what I was trying to portray.
I vote you should keep it. It looks great.
Thanks, Roel. Appreciate it.
All right, Scott. Till next time, we'll talk again. Thank you.
All right. Take care. Thanks, Roel.
Bye.
Bye.
Thanks again for joining us here at Self-Storage Investing. We really, really appreciate it. For more great content like this, make sure to click the subscribe button below this video. And be sure to follow us on Facebook, Instagram, Twitter, LinkedIn, and Bigger Pockets. You can also visit us at our main website at selfstorageinvesting.com, where you'll find even more free content, our ebook, and registration to our free webinars and education courses, and much, much more. Once again, for more great content like this, please click the subscribe button below. Thank you.